This episode of It's Your Call is one of a series dedicated to facing the mortgage crisis in Southern California, brought to you with the support of the Corporation for Public Broadcasting. Good evening, I'm your host, Roger Bowman. Our guests this evening are not strangers to KVCR or our series on facing the mortgage crisis. They're here to give us an update on the housing market and the economic strife we've all been feeling. In the studio with me this evening is Robert Hooker, Director of the Inland Empire Economic Recovery Corporation, and Dr. John Husing, one of Southern California's top economists. Tonight's show is pre-recorded, so we'll not be taking any phone calls. Now, before we get started with our guests, I'd like to let our viewers know that KVCR has organized a mortgage crisis town hall meeting, and you are invited. Join us tomorrow, Saturday, August 15th at 1 p.m. at the San Bernardino Library for 90 minutes of interactive discussion with the best of our local regional experts. Go to kvcr.org and click on Facing the Mortgage Crisis Town Hall to learn how to reserve your free seats. Thank you, gentlemen, for being here. Sure. John, let me start with you. I've heard reports recently that Riverside County especially is one of the hardest hit in the entire nation. I thought we were starting to climb out of this. How are we doing?
It's really the Riverside metropolitan area, which includes San Bernardino and Riverside, that they say that about. You have to do this in numbers. We have in our region 1.1 million houses and condos. Of those, 359,000 sold in 2004, 5, 6, and 7.
1/3 roughly.
Almost exactly 1/3 sold in that period of time. Most of the houses that traded in that period of time traded with either option adjustable, Alt-A, or subprime loans, which had triggers that caused the payments to go up dramatically at a set period out in the future. Where are we with, now that's 1 out of 3 houses. If we look at the price today, all of those houses are upside down. People owe more than they borrowed to buy those houses with those triggers built in. 50% of those houses have had a notice of default, which means they've been told you have 90 days to come to bring it up to negotiate with us to cure being behind on payments.
John, that's 1/6 of the entire population of houses and condos in the region.
You drive around out there in this region, 1 out of 3 houses you're looking at is in definite trouble, and 1 out of 6 has had a notice of default. 80% of those have gone back to the banks. Now, that's history. Where are we now? The subprimes were responsible for most of that. The Alt-A's and the option adjustables really don't hit us until September, October of this year. So there's a second wave sitting out there in front of us that extends all the way till September of 2012. So this problem is half done, but it has an extended period of time in front of us. That does not include 2 groups of houses. Those are just the ones that sold buyer and seller. There's also the people who, didn't see a house, or a SUV or a tummy tuck they didn't want, and thought that their house was a piggy bank. Unfortunately, those have to be added on because a lot of those folks are upside down now. And then in addition, we have the second highest unemployment rate in the United States, 13.6%. Highest is Detroit, of the major metropolitan areas. So you have people now in trouble who've had regular, normal mortgages and were doing everything right, but they're now upside down. So where are we? We're probably about halfway through this, but there's a lot of difficulty still sitting in front of us.
So are you suggesting at this point that with only 50% of the foreclosure crisis behind us already, that the next 50% is going to protract to 2012?
Exactly that. The housing market is not going to really recover until we get through this entire mortgage difficulty that so many families in this area face. This area, the Central Valley, Las Vegas, Phoenix, and some parts of Florida, are the center of this crisis for the U.S. because those are the hot markets, the fast-growing markets in 04, 5, 6, and 7. And so it was part of why we felt so prosperous. Now we're dealing with sort of eating too much, if you could think of it as, the indigestion that comes later.
So what I've been hearing too about these option A's, a lot of these people have opted to make interest-only payments or reduced
or less
payments.
than interest only.
Or less than interest only. And they are allowed to continue doing that until their loan resets.
And when it does, it causes the payment to go up to a normal amortization of the loan, which may double or triple what they have to pay, and a lot of those folks then at that point start to lose the house. The Alt-A's, what that was, and I use an absurd example, but it is something like this. I come into you, you're the loan broker, and I say, found a $500,000 house I want to buy. You say, great. Have you got enough income? Oh yeah, I make $150,000 a year. Great, what do you do? I'm the greeter at Walmart. Excuse me, we got a problem here. That kind of underwriting was going on out there. Now that's a ridiculous example, but I cite it to, the point with Alt-A's is they were not properly underwritten. The fact that the packages of these things ended up getting triple A rated by the rating agencies is just one of the great crazy absurdities of this whole crisis we've gone through.
So we've been feeling the pain now for almost, I want to say, 18 months.
It's probably a little longer than that. We're going into over 2 years now.
Of this downturn.
Yeah.
Caused primarily by the housing crisis.
Yeah.
So haven't we proactively looked in the past 2 years at these option A's and these other loans that are going to reset and decided to do something proactively to address that so that when they do reset, there's programs in place to cushion not only those individual homeowners, but our economy and our neighborhoods as well?
Don't you wish?
Yes, I do.
The fact is, it's a national issue, and the national policies put in place by the Obama administration essentially were two. One was to, if you have a Fannie Mae or Freddie Mac mortgage, and you were 105% upside down 5, you could refi at lower rates to get the payment down. They moved that up to 120%. But even at 120%, 20% upside down, our markets are down way more than that, so it really didn't help. The other thing is if you were paying 38% of your income for the mortgage, the federal government would subsidize the lender to get it down to 31%. Trouble is, when these mortgages reset, it's way beyond that. So neither of the two tools put in place at the federal level really have helped us in this area. The third possibility was called the cram down, where they would have given bankruptcy judges the power to change what was owed. Mm-hmm. The financial industry managed to kill that in the Senate. It passed the House. That would have helped this area. Wouldn't have done the financial institutions a great deal of help, but it would have helped a lot of those families in trouble here. The problem with all of those sorts of things is you ran into the whole issue of is it moral to help people who did really not very bright things? And, you know, as an economist, my thought is we got an unemployment rate of over 13%. We're back to mid-depression level unemployment rates in the Inland Empire because of this. You really do need to get it fixed. And the fact that some people did some things they shouldn't have done, that's just the price of policy.
Well, there's certainly a segment that has done things they shouldn't have done. They took interest-only loans and knew they couldn't afford when it reset, let's say. And they were really speculating that the housing market would continue to climb.
Housing prices never go down. It was
Sure.
the whole thought, yeah.
But we have a lot of people that have lost their jobs, that had standard 30-year fixed mortgages that can't afford them now. We have neighborhoods who have seen their property values decline, and they didn't do anything wrong. So we have to fix this. And if a small segment of people that took a gamble don't come out as bad as perhaps they should for their culpability of their participation, then that's what we have to do to get the entire economy back on track, don't you think?
National problem, got to be solved by Congress. Can't fix it any other way. That's the issue. We can deal with the side effects of this. And a lot of what Bob Hooker with his organization is doing is dealing with the consequences. But solving the problem when you have people this far upside down, that's national policy. And right now we don't have a national policy that deals with areas like here. That's why our unemployment rate is, like I said, the second highest in the United States.
And Bob, I'm not ignoring you. I'm continuing here with John for a few minutes. You mentioned something about the people wouldn't necessarily be hurt as bad if the cram downs went through, but that wouldn't be good for the financial institutions. Isn't it fair to say, though, that the financial institutions can get federal bailout, whereas the individual homeowners cannot? So therefore, why doesn't the financial institution bear more of the brunt of the crisis?
Ask the senators that voted this down.
The cram down. And we all know, and we've discussed this on
and by the way,
episodes.
You're not going to get, I think, any representative of a financial institution to walk up and say, oh, yeah, please do that to me.
Sure. They owe their
profit-making organizations.
They owe their shareholders a
duty.
Right. But in this particular case, we have a situation where the entire economy is being hurt, and their reluctance to accept, say, a cram down or principal reductions in their modifications is really disingenuous only to the extent that when they sell a property that has gone into foreclosure, automatically they have to sell it at the reduced principal because the market has gone down.
That's the part of this that from the financial institution side, I personally don't quite understand. That is, if I reduce what is owed by one of my clients, and they're able to stay in the house, the question is that a better situation potentially than having it go into bankruptcy or go into foreclosure? I get it back, I've got to fix it up, I've got to do all that stuff, then I have to sell it. Which way do I lose the most? And my instinct is they lose more with the foreclosure. Now, I don't think they think so, but that is really what the issue is. And institutionally, they certainly have come so far to the conclusion they'd rather let it go to what they call an REO, real estate owned, meaning foreclosed, they own it, have to sell it. That's what, by their action, they've caused to be the strategy. Whether that makes even sense for them financially, that you need to go talk to a banker. My instinct is it doesn't, but then I don't have a bank.
I would think that if it's a close call, this is not the economic circumstances in which to eke out that last penny at the expense of the homeowners that are already in place.
Have you thought of running for office?
John, let me ask about the federal response. As you mentioned that the program came out, Making Home Affordable, was 105%, meaning they would help you if your house was only 5% upside down.
That's correct.
And you mentioned that we've seen our economies decline to the point where I know homes are oftentimes 50% of the value.
Across the board, we're down about 42 to 43%.
In Inland Empire.
In the Inland Empire. So none of that really helps. And again, first of all, you had to have a Fannie Mae or Freddie Mac mortgage in order to qualify at all. And then you could only be upside down, originally 5%, now today 20%. The problem with that is when the average house has gone down 40%, it doesn't do anything in this market. Or, by the way, the Central Valley or Las Vegas or Phoenix or Florida, which are the markets in the most trouble.
But I'm challenging you to expand that. Was there anywhere in the nation at the time that came out that 5% above the original price of the loan was viable for anybody?
Yeah, there's a lot more area. Again, the areas I cited are the areas where it's not working. There are lots of areas in the country where it helped. It just didn't happen to help in the markets in the most trouble, and unfortunately we sit in one of them.
So they expanded it to 120?
They took it out to 120 because it wasn't doing enough at 105. They'd have to go to 140 before it would help here.
And likelihood, it doesn't look like that's not going to happen. That's not going to happen.
No. We're going to have to deal with the consequences of this and basically wait for it to run its course, unless for some reason something happens at the federal level that right now is not on the drawing board.
So you mentioned you have to be Fannie Mae or FHA backed loans.
For that program.
For that program. And that's ostensibly because the federal government's reach didn't apply to private industry. But Fannie Mae and FHA are either federal or quasi-federal
Well, now they're
backed.
completely federal. They took them over.
Right, but by virtue of the bailout, for those institutions that have not given back all the bailout money, aren't they now more or less quasi-federally managed? Couldn't
Not
that have
managed,
extended?
but they're under some pressure, and the government just recently issued a report looking at what share of problem mortgages some of the large institutions have in fact done some things to help their clientele, and the biggest banks were the ones that had done the least. Now, they had one that it was 100%, but it only had one loan. But the big ones, it's like less than 10% of problem mortgages that they had dealt with.
But it's the big ones that we gave the biggest bailouts to.
You should be running for office, sir.
I think I'm merely stating the obvious.
You would hope that this would be solved a little bit faster and with a little more attention by the major financial institutions who, quite frankly, participated in creating this mess.
The argument, obviously, is that they are, A, private corporations, and B, they have a fiduciary obligation to their shareholders to maximize shareholder profit.
Yes.
And so, therefore, they really shouldn't be acting in the homeowner's best interest. They should let the free market apply the mechanisms.
That is the answer to your own statement, is that you should let that occur. But first of all, I think there's a real question about whether they're always acting in the best interest of their shareholders by letting things go to foreclosure. Because foreclosure is a burdensome process. And I think this is a bit of the oil tanker, where you're trying to turn something to a different mentality for these large institutions, and they just haven't gotten there. Because I just can't believe that getting back all this property is the business they really wanted to be in. And then, of course, if you listen to their advertising, what do they say? They are community-oriented institutions. Well, excuse me, then why haven't they stepped up to the plate more? I'm a little bit skeptical.
More than 10%, you're saying?
I would think so.
Okay, so let's take it down to a more regional area. Bob, tell me a little bit about what your organization does, and let me preface it for our viewers. Previously, we had you on, and you told us about how your organization was organizing regional seminars, helping people avoid foreclosure. And we talked not only about that, but also with some of the people that give, later on in our series, that give those talks. Mm-hmm. Now we want to talk a little bit about the other half of what your organization does, really the more important work regionally. Tell us a little bit about it.
Okay, and just as an update for our seminars, we've had 5 so far this year, and we've been able to put 500 homeowners throughout those 5 seminars, together with either nonprofit HUD-approved counselors or direct representatives from their bank. And loan modifications have either been successful with those 500 or are in progress with those. So we count that as a huge success in our seminar program, and we will continue to have those throughout the year and drifting into 2010 also. But you're right, the bigger part of our organization, the Inland Empire Economic Recovery Corporation, is to deal with those assets, those houses that have been foreclosed on and are sitting vacant, causing blight, being vandalized, causing the continued reduction of real estate values throughout both counties, and really doing nothing to enhance the neighborhood or the whole economy as a whole. So what we are about from that standpoint is our program calls for purchasing those vacant homes that are bank-owned, going through extensive renovation on those houses, and then selling those to owner-occupied buyers throughout the Inland Empire. And in that, our mission is fourfold. One, we are trying to stop the spread of blight through vandalism, trying to stop the reduction of real estate decline by putting owner-occupied buyers in the houses, creating jobs for Inland Empire residents, and creating more home ownership opportunities. By that, and how we're accomplishing that is, since January of this year, we've been working with a lot of the national and regional banks who own significant numbers of vacant houses within both counties. And we started out talking with them on what can we do in collaboration with the banks to improve this real estate economy, and how do we go about purchasing some of these houses and putting people back to work and just really implementing what our program is about. Most of the banks have been very receptive to our program, and they understand that we're a nonprofit organization formed strictly for public benefit throughout both counties, and so they know that our mission is just that, to turn this real estate economy around to the extent possible that we can. And to be honest with you, our conversations went well, but they did stall at a time when we got to the point to where banks said, this all sounds really good, and this is a mechanism by which we, the bank, can alleviate and get rid of some of our bad assets, non-performing assets, and do some good for the economy. However, so that we, the bank, don't face potential litigation from our investors who they have a fiduciary relationship to maximize their returns, as you stated a moment ago, which is fine, as well they should. We, the banks, can't really discuss this with you at too much of an extent until you are able to come back with sufficient funds to buy perhaps large bulks of assets. And in buying those large bulks, taking some of the more troubled assets that the banks have, and by that I mean the houses that really the bank can't sell to a homeowner because they're not lendable. They've had illegal room additions done. No permits were achieved in doing those improvements. Or the kitchens have been ripped out. So there's no stove, dishwasher, cabinets, sinks. The condenser lines on the air conditioning units have been stolen and sold for copper. So the bank would have to invest into those houses to even sell them to an owner-occupied buyer. What they have said to us and what we have agreed to is that we'll look at those assets. We'll take those that they can't even sell. But again, the talk stalled because we didn't have a large sufficient amount of funds to come back and buy in bulk. We were initially financed by the County of San Bernardino and Sandbag and other organizations.
Tell us what Sandbag is, because that's not necessarily the most...
San Bernardino Associated Governments is what that stands for. And you'll see their signs on most of the freeways and highways. They're really all about transportation. But they so believed in what we're trying to do that they have committed a portion of funds to us. And recently, I'll tell you this, as of last week, we obtained a $1 million appropriation from the U.S. Housing Department of Development and Housing and Urban Development, HUD, has from Congressman Jerry Lewis, who was very helpful on our behalf. So we will be getting, as soon as it passes the Senate, an appropriation of $1 million to help our cause, help better our cause. But we realized with that and with the funds we already have, it still wasn't enough. Because with the amount of foreclosures that Dr. Husing has mentioned is already there and yet to come, we knew we had to go about this in a bigger way. So we went about raising private funds to come in and mix with our public funds and really leverage up the public funds to an extent that we could go in and buy in large bulk. And I'm very happy and pleased and excited to tell you that we have raised a little over $60 million from private sector to come in and help us do this. Now, the way it's going to work is, and what we offer to the various jurisdictions within both counties, the cities, is that we want to work with them, and we are starting to work with certain cities, whereas they take some of their tax set-aside funds they have, or other funds they have, and we come in with the private funds and leverage that up to 5.5 or 6 times. So if a city had $1 million, let's say, in a tax set-aside fund that they wanted to utilize for this program, we could turn that $1 million into $6 million with our private investment. What that does is it allows the city to tackle their problem 6 times greater than they could on their own. We've committed to them that all of the vendors we use, be they subcontractors, real estate professionals, whomever comes into play in renovating a house or selling a house, first and foremost, we'll look to citizens of their city to utilize and create jobs for them. We've gotten a good response from some of the cities, and we're still talking to others. But they, the cities, and us, we understand that in order to tackle this, it's going to have to be a collaborative effort from all entities.
Bob, I'm going to inject here, and let me dissect this a little bit. In talking to some of the big banks, we have learned that the real estate market is impacted because obviously homes are not selling right now. They are being foreclosed on, and there's a glut of the market.
No, totally wrong. Excuse me.
No, that's what I want. John, correct that.
Demand is now back to late 2003, early 2004 quantities. The market has shifted in the last 3 to 4 months dramatically. What's happened, if you think about it, is, first of all, we all know prices have come down. When prices come down, affordability goes up. I just recently looked at the series of numbers going back to 1988 and that answered this question. what share of the families living in the Inland Empire can afford our middle-priced house, half above, half below? The answer is 65%. Now, what that means is 65% of our families can afford the bottom 50% of houses in cost. That would normally regard it as a seller's market because you have potentially so much demand out there because it's so affordable at these prices. So what has happened is demand has picked up dramatically. It bottomed in the fourth quarter of 07, all the way through 08, and now into 09. It has been going up because affordability is there. One of the consequences now is prices stop declining. Last month, for the first time, we actually had a very tiny increase in price. And hopefully there's a signal being sent to the people sitting out there on the sidelines of, well, when the market hits bottom, I'm going to go buy a house. It's there. It's now. So
John,
demand has hit the market rather dramatically in the last, particularly just very recently.
but then you would expect to see some of those for sale signs on your block start to disappear off those lawns.
They're getting multiple offers on a lot of these houses now. That is one of the things that is going on. Originally, it was, the odd person had the courage to go buy. Now they're getting repeated instances of multiple offers.
Now,
so it's going up ever so slightly in price over what it was put out there at.
Okay.
So the market is sending some good signals. They're not all good signals yet, but it's, thank God we finally have something good to talk about because I was not being invited to anybody's cocktail party anymore.
The banks told me that obviously the economics are that the demand isn't there to buy up all the houses. What they did mention, and tell me if this is part of the demand you're seeing, is that if they go ahead and foreclose on homes, they don't go through remodifications, they don't do any of that, they just take the home and then they put it up for auction, that there are investment corporations that are buying very large blocks of these homes, sight unseen, because the prices are so low. They know their investors are going to profit.
Two kinds of strategies are going on here. One, which is a strategy we don't mind seeing, and one is a strategy where we'd like to tackle the people and shove them off a cliff. The strategy that we don't mind seeing is investors buy the houses, make the changes that needed to bring them up to snuff to be able to be sold, and then are selling them to owner-occupants. That is a good strategy.
Do we have an example of them?
I don't know them, but I know that some of that's going on.
And Robert, that's what you do.
That's what we're doing.
That's what he does.
Yeah, that's what we're doing, yeah. Because as John said, and I know this is where he's going, but the fact that, as you mentioned, large investment groups are coming in and buying these assets and renting them out, it does nothing to stabilize that neighborhood's economy and real estate. Those houses typically don't get maintained to the level as they would with an owner-occupant in it, and it also overloads the schools then with more children from a rental basis. Part of our program, or part of our mission, as John said, is to stop that as much as we can, because we know the only way you stop the decline in values, one way, is to get an owner-occupant into that house. You don't want an investor who lives in Texas or Florida or somewhere else who owns 100 houses in an area. He's never seen them. He only cares about getting a renter in there to cover, the amount that he needs to make his loan and make his profit, and really doesn't care if the yard is taken care of or if the house is taken care of, other than vandalized. And so neighbors who live in the houses around that, they don't like that either. They like a program such as ours and others like ours that come in and say, look, we are renovating this house. We're going to make this house probably the gem in the neighborhood, which is our goal. And then we're going to sell it to somebody who will live here and be one of your neighbors. So it does nothing but help that entire neighborhood.
Bob, would you agree, though, that you're one of the few that are specifically trying to do that?
I wouldn't go so far as to say that. You have, as I said, there are two strategies the investment community is using.
Yeah.
One group, buy, fix, flip.
Yep.
And as long as they're flipping owner-occupants, that's fine.
Yes.
And particularly if they're not leaving them out there for a long time, but they are in fact flipping them in a hurry because they can make money doing it. Good strategy. They're doing what Bob's group is doing, but they're doing it without having the involvement. The other group is the group that we really would just as soon, like I say, shove off a cliff. I'll give you a specific example. I do a lot of consulting work. I get a call from a group in Northern California. What did they want? They wanted me to advise them where they could buy houses, rent them, hold them for 5 years, and then after the price had got up, sell them. My reaction to that, not only won't I be your consultant, I will do everything in my power to stop you from ever being successful with that strategy. 3 reasons, and it's why Bob's organization, because that's the counter to those people, is so crucial. Reason number 1, as he says, renters do not take as good a care of property generally than owner-occupants. I put my elbow through the wall and it's my wall, my wife slaps me in the head. Your wall, I call you up and say, hey, there's a hole in your wall, if you're my landlord. First issue. Second issue is talk to the police about neighborhoods with large numbers of detached single-family rentals, and you will find that is the highest calls for police service that they face. If it's an apartment house, they can work with the management to have tenant programs and all that. But you get, one from Texas, one from Washington, one from Maine, and one from Florida owning the houses in the neighborhood. There's nothing you can do except deal with the crime problem. The third is if you get a lot of that, and the city of San Bernardino is a perfect illustration of this, where there's large numbers of rentals, property values sagging all over the place, because everybody had the same strategy. Buy, rent, hold, sell, except the values went down because the whole neighborhood was deteriorating. So you then get bottom-feeding guys and gals coming in and buying these houses, renting them for very little, and now you have tenants that are moving from door to door to door trying to get the lowest possible rental. Go to the schools and say, what's it doing? The class in September isn't the same students that are in the classroom in June. How do you teach? So there are tremendously negative side effects of large quantities of rentals being injected because of this crisis into our community. That's why his group was set up, was to fight those people. For one of them to call me, big mistake. I got my bazooka out.
Now, John, let me take a contrarian view for a moment, and that is, and I appreciate what you're saying, in a normal world, in a normal market, having fewer rentals in attractive single-family detached homes is obviously a positive for the neighborhood. But in this circumstance, where what we have is a quantity of vacated homes, isn't it better to have renters in them than for them just to be vandalized, vacant
You're setting
homes?
up a false choice. We have a housing, this is the weird thing, we have a housing shortage in Southern California. There are far more families out there that would like to have a house that they could afford and live in as owner-occupants than we have houses for them. And what you're setting up is a situation where the market's now at the kinds of prices where they could buy them, and here comes a group of investors who want to buy them up and turn them into rentals and stop these people from having the opportunity to buy and live in them. That's what's going on here. And we finally have housing affordability, but we now have competition that the potential household that could live in the house has to put up with some guy with $50 million who wants to play a game in the market. With all due respect, that person, as far as I shove them off the cliff.
Well, indeed, there's an
By the way,
air
my
out there.
consulting practice just went completely down the drain.
That's what we're here for.
Thanks.
John, clearly, a lot of unwise investment speculation is what got us into this situation. But free market believers think that if right now the prices are so depressed, if people come in big blocks of private investors, buy up these homes, yes, instead of buying in the stock market, they're buying in real estate, but they're going to hold them for those 5 years and the price is going to go up. At the time it goes up, then likely the renters that can't afford the then in the future higher prices will see their leases expire. They'll see the rents go up proportional to the housing price go up, and they will move out. They'll relocate. And at that time, probably owners will come in that can't afford to get the loan and buy the home.
Let me give you a specific illustration of what's wrong with that whole strategy. Moreno Valley in the 90s. That is precisely what happened. and it almost destroyed Moreno Valley in the meantime. Almost all brand new neighborhoods. Along comes a major recession because of aerospace. People start losing their homes in droves. HUD, in its wisdom, became the Department of Housing and Urban Disaster, packaged them up, shipped them off to landlords. Landlords bought them, turned them into massive numbers of rentals in the city. Property values did not go up. They continued to slide. The town's crime rate went through the roof, and it took over a decade to get that town back to where it had been before that all happened. With all due respect, in housing policy, there are public consequences. And the consequences, like I said, calls for police service, declining property values of the neighbors, and impact on the schools, I believe, as a matter of policy, overwhelms any other consideration. And the fact you've got somebody that wants to go out there and get rich, with all due respect, they ought to go someplace else. And that's what we're trying to stop.
Roger, one thing, too, if I may interject, is if we were in a market where housing affordability was low, house prices were high, and the average person couldn't afford to buy but only could afford to rent, the argument of a large investor coming in and buying a block of assets or houses and renting them out, it might hold a little more water because you would say, well, at least they're providing shelter for people. But as Dr. Husing said, we're not in that market. We're in the market where now affordability is at the highest it's been in several years in this area. So by those investors coming in and buying those houses and renting them out, as he said, is preventing people who could, because of the pricing, purchase those houses and become homeowners. Now they've taken that house off of the market, and they're really depleting the inventory that we have available. We still do have a shortage of houses.
All right, so let's examine this for a moment. We have an inventory, and let's say that those people jump off the cliff or get pushed off. So the houses are available for those that can afford it. Right now, those people need to get loans. They don't have jobs because we're at a very high unemployment rate.
Well, we have a 13% unemployment rate. 87% have jobs.
Okay. It's fair to say a lot of people have taken price cuts. There has been, and this isn't, I don't know of any numbers of this, but there's been a lot of job mobility where people have lost a job in one sector, become reemployed at a lower income level. And they're not on the unemployment coffers, but they've seen a decline in total household income.
We are not seeing, when you go out and talk to the real estate agents, we are not seeing a lack of demand. That is not one of the things that's occurring.
How about lack of lending?
Lack of lending is a different issue, and yes, that gets back to the banking crisis and the fact that you had no secondary market for loans. Very quickly, local bank makes a loan on a house. They haven't got the money anymore. They lent it. They have a piece of paper. They put a bunch of those together, and they sell it to a group, get their money back, make more loans. What's disappeared is not the bank wanting to make the loan. It's the secondary market willing to buy the package of loans from the local bank to refinance it so it can make more loans. That's where the breakdown in the system has been. That's what the federal policies have been working so hard to correct, and it is starting to work. We're starting to see some loosening up in that secondary market because that same process was used for student loans, auto loans, consumer loans, business loans, and mortgage loans, where you package them up, sell them to the secondary market, get your money back, make more loans. You got stuck because you couldn't get rid of the paper at their local credit union or at the local bank.
Now, the secondary market saw the bottom drop out because it bought paper that was rated as AA, prime, AAA, beautiful, risk-free paper at a fairly high interest rate, as subprime loans command. And that seemed like the golden egg that the goose laid. But in fact,
it was a goose. It
was just an artificial rating on artificial loans.
That's right.
Back to that Walmart greeter making the $150,000.
Yeah, what they call liar's loans.
Well, now as long as the loans themselves go through the due diligence process, why wouldn't the secondary market be there for loans that have the built-in quality?
Fear.
Is it fear? Is it lack of trust? Has our rating companies squandered their credibility?
There was such fear in the financial markets that nobody trusts anybody's underwriting criteria. And there's a thing called the TALF. Everybody's heard of the TARP. But the TALF was I can't remember what it stands for. But essentially what it was the Fed working with the Treasury, putting together a program where investment houses could borrow money at a very low rate to buy these packages from the banks to get the money getting back to them to loosen up the system with guarantees on the paper to get that restarted. That is one piece of the federal policy that is absolutely working. And that has really helped to the point where there's discussion about no longer needing it because it is beginning to loosen it up. But that has been a real problem, is just the lack of ability to, even for qualified buyers on a 20% down FHA guarantee or maybe 3% FHA guarantee, all that stuff. If you had all the paperwork straight, you couldn't get the loan. Well, that's been a problem. It is becoming less so. It is not yet back to normal.
And because it's not back to normal, that's what, Bob, prevents those people that can't afford those homes from snapping up those homes. Isn't that true?
Exactly. And again, you know, you say, well, if loans are hard to get, how are houses selling? Yes, loans are harder to get than they were 5 years ago or 3 years ago, but they should be.
They should be, yeah.
We should make sure that people are qualified to purchase a house and they can make the payment and they do have the income to support that. That's kind of what we're back to. We're back to the old days where you actually had to show that you could afford the house, and there's nothing wrong with that. But those houses are selling, and banks will tell you that their assets they have, their houses, that require little or no work, they can just really put them on the market and sell them, they're getting multiple offers, and the prices are driving up. Well, those are not the houses that we are proposing to buy from the banks. The ones that we were going after, as I mentioned earlier, are just those that they can't turn around quickly, that they will remain on their books for a long time. And all the houses we look at have been owned by the banks for at least 120 days. And most of them are averaging 250 to 400 days the banks have owned these houses, and they've sat vacant. They're not investing into them to get them up to a lendable standard, so they're looking to organizations such as ours, and we're not the only one. There are other very good organizations out there attempting to do the same thing. But although, you know, on the good assets, the good houses, the prices are being driven up, on the ones that require a lot of work, they are looking to alternative mechanisms. And yes, those are the ones we're going after. That's the niche we're in, and those are the ones we want to tackle. And we want to get those before the investors who want to rent them get them.
Okay, so let me clarify here. There's two opposing views that have come to the table here. The first is that things are going to be bad through 2012. So we have 50% of this entire crisis ahead of us. Things are bleak. But the opposite thing that's come out is that we have affordable homes now. Lending is starting to loosen up. The secondary market is starting to help the banks make those loans. So we should be willing to allow those homes to sit vacant long enough for owner-occupied lenders or for new owners that are going to self-occupy those homes to go into those homes. In other words, correct me if I'm wrong, what I'm hearing is let's not encourage the homes to sell to investors that are going to flip it and in the meantime put renters in it. Let's bear the pain of having vacant homes until such time as new occupiers will
If
buy
I may
those homes.
interject, you're already bearing that pain because listen to what he said. You've got houses that have been sitting on the banks for multiple months because they need the work to be brought up to snuff so they can be sold. And that's the niche he's going into.
But isn't the market for private investment firms that are buying very large blocks of homes, Moreno Valley style, aren't those exploding now just over the past few months?
That is true. That is true. Mm-hmm. The question is, how fast would they... First of all, I'll tell you what the issue there is. All right, let's talk about people who specialize in going into those bottom-end homes. Are they going to take them up to the kind of quality that an organization that's working with the local governments is going to take them up to? Or are they going to slap on a coat of paint, do the minimum necessary so they can rent the thing, and then get it out there and rent it? Experience shows us it is the latter. That is what they will do. Because we've been through this. We did this in the 90s. We saw it. Go drive around the city of San Bernardino in the downtown neighborhoods from basically 5th Street on up to about 30th. And that whole part of the city, that's what happened there.
So, Bob, we're in a race, basically. Get the homes that are in the inventory. If we can't sell them directly to the new owners that are going to occupy the homes, then we need to sell them to companies like yours that are going to make sure that they, in turn, go to the owners that are going to occupy the home, as opposed to the investors that are going to flip them.
That's our goal. I mean, that's our goal. And we're not the only company or only organization doing that. There are others that are doing that. But yes, you're exactly right. The mission is to take those, as I said, and I hate to keep repeating it, but to take those more troubled houses and turn them into owner-occupied dwellings. Because, as John said, they're already out there. The banks have had them for in some cases, several years. So, we're not, it isn't the fact that we're trying to snatch these up the minute they become foreclosed on to prevent the investor who's going to rent them out from coming in. We're taking the ones that are continuing to drain the real estate values. They've been spray painted, they're graffitied, vandalized, just tearing down neighborhood values. Take those and turn them into a showcase home for the area.
How do you
put
do
an
that?
owner-occupant in there?
So how do you do that, Bob?
Well, what we're doing is we're not just painting and carpeting like so many of the investors do. We're going in and we're replacing flooring, we're replacing the carpeting, the tile, the vinyl, whatever it may be. Most of these houses have no kitchens, so we're putting in full new kitchens and appliances. We're looking at all the electrical, bringing it up to code. We're putting some environmental and green items into the houses, such as some type of different enviro-sensitive air conditioning units and dual pane windows when they call for that. So we're trying to adhere to some green standards so that we achieve some energy efficiency. And we're trying to make these houses, when we're done, and we put the for sale sign in the front yard through a local realtor, that they clearly are worth the money that we're asking. And we're not asking over and above what the market will bear. We're going back in at whatever the houses are selling for in a particular neighborhood.
So you're saying you're taking a window busted out, spray painted graffiti home, putting the bus in front of it full of remodelers, and then at the end move that bus.
And
that's the showpiece for the neighborhood.
That's our
I went
goal.
out and toured some of the kinds of houses we're talking about. I went home and took a bath. I mean, there is a lot of stuff out there that people could have as affordable housing that can be brought up by the kind of program that Bob has. But right now it's sitting up there and it's hurting every house in the neighborhood. The kinds of things that have gone on in the past is you've had landlords go in, paint over the mold. I mean, their interest is in getting people in there as fast as they can, and because that's in their economic interest. Bob's group, because it's affiliated with the two counties and a lot of institutions locally, that's not the major goal. The major goal is to increase the value of housing within our communities.
Okay, so how much resistance have you had, not just with the banks that will allow you to purchase them, because I imagine they're happy to unload those basically on an organization that's going to fix them up, but from the cities and from the counties, from the administrative side of your dealings?
Well, we haven't had any resistance from the cities. Now, some cities have their own programs in place, and those that do, they're working very well, and we don't want to disrupt that. But most cities do not, and you can well imagine in this economy, most cities have downsized their staff. So, what we're offering that they like is the fact that we're coming in, offering the staff that we have to help them with this problem, offering the funds that we have available to tackle it in a bigger way. It costs the cities no money, and to the extent that they invest in it on their own, they get a return on their investment, whereas they can take that money and buy more houses. So we haven't had much resistance from the cities.
What's the motivation then for the private investors that have helped you accrue that $60 million?
Well, the private investors, they do get a return on their investment, as they should. They're taking a huge risk, and real estate is a risky business. It always has been, even the best of times. That's why housing developers make such high profits in the good markets, is because it is a risk business. But knowing that they do get a return on their investment, and then we take their money and turn it back into more assets. The $50 million that we have raised actually on an annual basis turns into $150 million, because our program is 4 months. 30 days to renovate a house, 3 months we're allowing to sell it. And we think that's very generous, seeing how sales are going. But taking that 4-month program, returning those initial investment dollars to the investor along with his proceeds, they then reinvest that funds. We're actually turning those dollars 3 times annually. So as I said, $50 million on an annual basis turns into $150 million, which will allow us to achieve our business plan, which is to acquire, renovate, and sell in excess of 400 houses per year.
Okay, and those are mini remodel projects, is that correct?
Some are mini, as John said, some are extremely
major.
extensive. You have illegal garages that have been built. Well, you have to demolition that. That costs money. Then you have to fix that exterior wall where they knocked it out because they added a different garage, or they've added 2 or 3 bedrooms that when really the house is a 2-bedroom, it's now a 4-bedroom. Permits were typically not gotten or received for those. So yeah, we have to do a lot of extensive renovations on these.
Is it fair to say that's putting some of those people that became unemployed in the construction industry back to work?
Absolutely, absolutely. We have on our website, if I may, which is www.ieerc.org. Tough one to remember. We have a call there for all contractors, real estate people, anybody who would be involved in selling or renovating a house, to go on there, fill out our request for qualification. We will vet them, make sure they're licensed, bonded, insured, in good standing with the Department of Corporations, get them on our approved list, and put them to work as we can. They have to be Inland Empire-based companies, because that's our focus, is to put Inland Empire people back to work.
Okay, John, let me ask you a question before we close, and that is, we talked a little bit about those people that did things they shouldn't have done, and maybe they should see the benefit now of having the lending programs help bail them out. What about the people that are upside down, who did everything they were supposed to do? The ones that want loan modifications equivalent to what the distressed people are getting, but they haven't defaulted. They haven't done anything wrong yet. Shouldn't they be entitled to them?
The problem is, honestly, none of regardless of which category you are, the people that have tried to get help, maybe you didn't deserve it, the people who deserve to be helped and haven't gotten it, neither group is being helped in this current environment, really in any significant way. That's the big issue, because the property is too far upside down. That's the major problem. It's a national issue. We need a different national environment to fix this. And until we get that, what we're going to be doing is dealing with the consequences, which is what Bob's program is all about, as well as the people that are buying to fix and flip without having it. It's the rental piece that we're really fighting about. But we're dealing with the consequences of a crazy period. 4 years of craziness in prices. When we got down to the point where only 18% of the families living here could afford the houses here. And today we're at a point where 65% can afford. That's the difference in the price. But we always had a housing shortage. We never fixed the shortage. It's just the speculators got in and drove the market crazy.
Okay, so what we're saying now is we have homes that are on the marketplace that have declined in value so much that, like you said, 1 out of 3 are upside down.
1 out of 3, not including the people who took money out of their house and rewrote the mortgage, and not include the people that are losing them because they're unemployed.
So the people the people that are upside down and they aren't necessarily defaulting right now, should they hang on? I mean, some of these people have lost hundreds of thousands of dollars in property value.
I would say the answer to that is probably yes, just simply because we don't know at what point a combination of the national banks and the federal government finally come to some kind of an agreement. So I would say yes. First of all, you get to live in the house. But second of all, I would suggest that you do, because we may get something that's not evident right now. But in the meantime, we are dealing with a continuing flow of foreclosures out of the situation that so many people are found in. And by the way, I should...
Closing 10 seconds, John.
Closing 10 seconds is, we don't get out of this recession till we solve this problem.
All right. I'd like to thank our guests, Bob and John, for joining us this evening, and thank you for watching. If you'd like more information about tonight's show or to reserve your free seats for tomorrow's town hall in San Bernardino, go to kvcr.org and click on Facing the Mortgage Crisis. Please join us next week as we resume our live broadcasts. I'm Roger Bowman, and remember, it's your call.
For more information about this project and related topics, visit kvcr.org and click on Facing the Mortgage Crisis.